Now, let's try to understand the return on equity for a company. So basically, return on equity simply shows that how much net income we have generated for the equity shareholders of the company. So if we go above and see the PNL here. So within PNL, we know our sales is there and our cost of goods is 250. So based on that, we got a net profit of 150. Then there is an operating expense and interest expense, which gives us the net income before taxes of $80. And then we have taxes of $24, which gives us the net income of $56. Now this net income of $56 is being earned, but at the same time we need to know how much equity shareholders will be getting from it, right? Because equity shareholders are the people who have invested the money in the company. So we will be saying the company is having equity shareholders of $270, and by investing $270 from equity shareholders, they are earning an I can say net income of $56. So what we will be doing, we will be doing 56 divided by 270. But what happens in the industry generally, that this equity doesn't become static throughout the year, because in between the year there may be cases where new shares are issued, or there may be cases when shares have been buyback. So shares can increase or decrease based upon the company's policy and call. So what we do again, we do simple the average of opening equity and closing equity. So if we see the situation here, we can see that our equity shareholders are having $270 in current year, and in the previous year it was $225. So we take the simple average of both of them to have the balanced overall equity, how much we will be having, and the same principle will be applied throughout the ratio analysis, that we take the average in these cases where the things keep on changing based upon point of time. So right now the return on equity is 22.6%. Now this 22.6%, how Apple company uses it, because they can see that how much money or how much profit is generated for their shareholders, right? They also help to decide if some investments needs to be done, and are their investment from the equity holders generating sufficient returns. Finally, let's suppose that if the return on equity is very high, then the company is having a lot of money within their pocket. So what they will say, they will say that for this $56, we will be distributing certain money out of it as dividend. So dividend distribution decisions are also taken. And finally, efficient utilization of money, how much has been done, that is also being checked. So this is the return on equity.